So bank runs have been a part of the economic landscape, often causing widespread panic and devastating effects on the economy for many, many years. Now, in the past, people who feared their banks would fail would withdraw their money in masses. Now, this caused banks to suspend business and leading to more people panicking and withdrawing their funds even faster. Now, this would lead to a vicious cycle that could spread contagion and cause other banks to fail as well. Now, to prevent such a scenario from happening again, the Federal Deposit Insurance Corporation, or the FDIC, it was created in 1933 under the Banking Act. Now, the FDIC was designed to insure bank deposits so that people would have faith that their money was safe in the bank. Now, for every $100 deposited, banks would be required to put a few cents into the FDIC's deposit insurance fund. Now, this fund is then used to reimburse depositors if their banks fail, up to a certain amount. Currently, that amount is $250,000. So the FDIC's primary objective is to protect insured deposits. However, the agency often goes beyond its mandate to ensure that the bank's customers are not left stranded. So when a bank is on the brink of failure, the FDIC and regulatory agencies, they get involved. They usually arrange for the bank to be sold to another bank, usually a larger one, and a bank that's close geographically to the failed bank. Now, the goal is to make the process seamless and for banks' customers to ensure continuity of service. Now, in the past, failed banks have primarily been small ones, but there have been some exceptions. For example, in 2008, Washington Mutual was the largest bank failure in the United States history. Now, most of the accounts, primarily personal ones, were insured, and the bank was sold for enough money to cover these insured and the uninsured accounts. However, the bank failures of 2023 have not been routine. Now, Silicon Valley Bank, the vast majority of depositors had accounts of more than $250,000, which means they were uninsured. Now, the bank failed so quickly that the FDIC had not lined up a buyer before it had to close. So the deposit base was a very close-knit group of venture capitalists and their portfolio companies. And when a few of them got worried, they all started to panic. Now, the U.S. government had to announce that all customers with deposits in these banks would be protected, guaranteeing not just the insured, but also the uninsured. Now, this was aimed at stopping any further economic damage from these businesses not being able to make payroll and other expenses that they might have. Now, reimbursing all of these depositors will come from the eventual sale of the bank and the insurance fund. Now, many experts are worried that the amount banks have to contribute, they may go up, and bank fees, they're going to increase as well as a result of this. So, however, the process, while messy, worked the way it was designed nearly 100 years ago when it was first implemented. Now, as a result, it's still safer to keep your money in a bank rather than under your mattress. All right. So, in conclusion, the FDIC is a critical component of the U.S. financial system. Its mandate is to ensure that people have faith that their money is safe in a bank, and it has been largely successful in achieving this goal over many, many years. Now, while bank failures do occur, the FDIC has a plan in place to ensure that people are protected and the impact on the economy is minimalized. All right, so there are some costs involved, such as increased bank fees, and the benefits outweigh the